Welcome, everyone, to another collaboration episode of CRE Unplugged and Thesis Driven. I am so happy to be joined by my CRE Unplugged co-host, Ryan Elazari, and our dear friend from Thesis Driven, Brad Hargraves. Gentlemen, welcome. How are you doing?
Great. Super excited to be here, Nadine. Thanks for having us.
Yeah,
Love it.
doing great. Can't wait for this episode.
Brad, we continue to be surprised that you keep coming back, and we're going to keep taking advantage of that. So thank you so much for joining us. So to kick things off, as they say, the riches are in the niches, and it seems to be holding true to real estate asset classes as well. Data centers, cold storage, student housing, you name it, formerly unloved corners of real estate are now the capital market belles of the ball. Gentlemen, what is going on? What is driving this shift? And what should we be keeping our eyes out for? Brad, I'd love to start it off with you.
Well, Nadine, I think this is one of the biggest macro trends in real estate right now. Huge gravitation of capital to niches, and that's driving some of these niches to become more than niches, to evolve into established asset classes of real estate. Data centers is probably the most notable example of where that's happened over the past couple of years, and there's a lot of macro reasons behind that, but you even look at things like industrial outdoor storage, marinas, even RV parks and cell tower leases, and say, hey, these are becoming established in the way that you certainly didn't see 5, let alone 10 years ago. And it all really comes down to one fundamental driver here, and that is a search for yield. Investors have been playing the same game for the past 10 or 15 years, and it's been working for 10 or 15 years. Value add multifamily, maybe some retail, maybe some industrial, maybe some office, all the same food groups, and it worked. Opportunistic, value add, like all those strategies worked largely because of cap rate compression, because interest rates were going down. They've been on this steady slide from 2009 all the way to 2022, and that's brought cap rates down. And so if you're, you could be a pretty terrible real estate operator, and if you bought some value add multifamily in a good city in a Sunbelt state and you put a little lipstick on the pig, you would generate a great IRR. Well, that play is over. Can't run that anymore. All those investors that, would have otherwise been doing 150 unit garden style Class B deals outside of Phoenix are scratching their heads saying, how do we get yield? How do we get yield in an environment where, the 10-year is at 4.5? And that's driving them to lesser known categories of real estate, things like all the categories I mentioned earlier, plus many, many more, as well as I would say operationally intensive real estate. So different classes and parts of hospitality, for instance, is a great example of more operationally intensive real estate, branded residences, all sorts of things that you could imagine. That Jenna, we just did a piece on extended stay hotels in Thesis a couple weeks ago. So all these different asset classes. Oh, did one on healthcare housing, homes leased to Medicaid care agencies. So seeing a big flood of capital, a lot of interest in these niches. The question for a lot of institutional investors is, how do you scale this? Great, you can do, a few 10, $20 million checks, but can you put $500 million into these? And that's still very much unanswered.
Yeah. Ryan, what's your take?
I think I agree with a lot of what Brad has to say here. I think, you wrote this on your thesis-driven newsletter about how family offices are usually backing these niche assets, which is really perfect for them because they could just be hyper-focused on these type of assets. My personal experience, I've invested in a music studio building, and I probably wouldn't have invested with them if I didn't know that the operator had a track record of operating that asset. So that made me feel comfortable to back them. And they ended up generating really high yield because they knew how to operate it, but they also understood how the market rates were lower than what it should have been. And I think that's really the key, that if you're going to give a check to people who are going to operate these niche assets, you kind of need to know that they actually have experience with this type of asset and it's not something that they're just going into just because it looks attractive. Well, would you agree, Brad?
Yeah, sort of. I mean, obviously, it's hard to argue that, like, oh, experience doesn't matter. But you're also seeing this parallel trend of, entrepreneurs who have seen other asset classes in real estate and know how to scale them,
Mm,
coming into these niche assets and saying, hey, yeah, these bumpkins have been doing it for the past 10 years, writing, $3, $4 million checks. Let's bring my expertise doing 200, $300 million multifamily projects, master plan communities into this category and institutionalize it. So I don't sort of want to say that like there is a right and a wrong way to do it. And ideally you can marry both of those. And it leads to a trend I'm getting increasingly interested in, which is this need for a lot of people to find co-GPs. Because really what those two people should do, and whether they have the ability to check their egos enough to do it, is they should say, yeah, I have some expertise here, but someone else brings something different to the table. Usually one person has niche asset specific experience. The other person may have
hmm
capital markets and scaling experience. Let's co-GP this, come in, do a partnership, do a JV, what have you,
hmm
makes way more sense. Because if you're an individual writing a check, you know, doing what's always been done, betting on the right asset class makes sense. But if you're coming in, if you're a family office, if you're a private equity firm, if you're an allocator of any sort that has to write bigger checks, you can't trust someone necessarily who's, been with the category ever since it got started 20 years ago to know how to deploy $150 million over 2 years.
hmm
So, yeah.
Super interesting on the co-GP concept. Are we seeing an increase in that, or is it, it'd be better if we did see more of that?
Yes and yes. I mean, you're certainly seeing it. A lot of family offices, for instance, this new generation of platform investors that's coming and saying, hey, we're bringing capital, we're bringing some like standardization expertise. We'll do your reporting, we'll do your back of the house, all that, but we need to find a sector expert.
hmm
I was sitting down with one investor. We're doing a deep dive on his platform coming up pretty soon. And, he is basically acting as an allocator, trying to find these niche operators that, know their sectors, but like don't really have the expertise to, go to Blackstone, go to KKR, go to Carlyle and raise a couple hundred million to scale it, and saying we are going to give them capital, but more importantly, some of that back office expertise to build a real platform here that in 3 years can be the aggregator and go get that institutional capital or, collect enough small assets to flip it to the aggregator. So you're seeing a lot of interesting strategies here on how institutions are tapping into these niche asset classes.
And I'll address this to both of you, whoever wants to tackle it first. Which of the trends that we're seeing in some of these emerging niche asset classes do you think is an actual sustainable shift? And which do you guys think is more of a spec bubble? What do you guys think?
I think medical office buildings probably could have like a long-term growth there. You're seeing Americans 65 or older, they're going to reach to 80 million by 2040. So there's
hmm
a lot of leeway to get office buildings to increase in value. I think I saw that year over year it's at 239%
hmm
in that sector. Also law offices, especially law office that are like near the courthouses or near police precincts. That's become very popular, especially I read somewhere that in Birmingham, Alabama, that's become a very popular type of asset class. So I would say those two. Brad, where do you see it being a spec bubble?
So, some of this is it's just specialization. So like needs that always existed out there, are, they're now um considered their own asset classes versus like all lumped into one thing.
Hmm.
I do get concerned about some of the flood into hospitality, and that's lessened a lot. But I think there's still like more rounds of punishment that are coming for everybody who bought Airbnb homes
Yes.
during the run up. I think that you have a lot of owners that are struggling, and certainly with rates staying high, you're gonna start, and especially if there's any kind of like economic cooling on the horizon, tourism dropping, you're gonna see a lot of Airbnb owners start throwing in the towel, and
Yeah.
you know,
You're
you're
already seeing that.
you're already seeing it,
Hmm.
especially, U.S. Southwest markets, Phoenix, Palm Springs, things like that. I think that's going to spread to more markets. So
Yeah.
that's an example. You've just seen a tremendous amount of capital flow into data centers as well. And I hesitate to stand up here and say that data centers are a spec bubble, but you do see what happened when, DeepSeek had its kind of phantom announcement of like, yeah, this model is, 100 times cheaper and leaner than these other models. Everyone was standing in line to short the data center REITs.
Yep.
I think it's only a matter of time before you see another DeepSeek that is more real,
Mm.
that does meaningfully reduce the cost of those models. And not saying data centers aren't valuable. There's obviously like a real need for them today and going forward, but there's just the velocity of capital going into that sector right now gives me the heebie-jeebies. That's all.
I agree with you. I agree. Yeah, I don't think we're going to see data centers go away at all, right? But to your point, I agree with you on that one. I think we're in a bit of a sustainable shift, in my opinion, as it relates to certain of the niche asset classes, right? As it relates to data centers, single family rentals, the manufactured housing and all of that. But to your point, I do think we're going to see some cooling off in some other sectors as well. And, just trends are changing, population is changing, consumer preference is changing, everything is shifting. We talk a lot about here, guys, on return to office and hybrid work and how much proximity is going to matter to people and commute time and all of that. And so I don't think now that these factors have been surfaced and we're talking about them and people are addressing them, niche asset classes aren't going away. If you go back far enough, some of the major core asset classes today were once considered a niche asset class at one time. In economic history, I just think we're seeing them emerge at a faster rate to that point. So great. Awesome discussion. Moving on. Speaking of economic uncertainty, and volatility. Question everyone is asking: are we heading into a recession, or are we just tired? So every economist has a different answer, guys. The bond market's giving off soft, turbulent landing with some turbulent vibes. CRE debt maturities are saying don't take that seatbelt off just yet, but markets are up, unemployment's low-ish, cap rates are leveling, and yet everyone feels broke and annoyed. So, Ryan, I'd love to kick it to you. What do you think? Are we heading into a recession?
I don't think we're headed to a recession, but I think there's some cases where we might. Right now we're recording this on May 28th, and
Mm-hmm.
yesterday Trump announced that he was delaying the tariffs negotiations to the second week of July. So kind of bringing the 27 nation bloc to come and negotiate and come to an agreement. So I think if the tariffs kind of get died down, that will help. Consumer confidence was announced; it was up 14%, so that's a good indicator that we're not heading to a recession. But the one thing that does worry me is housing investments, and that's something that Ed Lerner in 2007 published an article saying that could be a leading indicator of us going into a ongoing recession. And right now, the residential investment market is at a crossroads. You're seeing a lot of permits being going down. Values have dropped. You're seeing a lot of cases where rental prices have gone down as well. So if those don't change in the upcoming future, then I think there's going to be some challenges, and we're going to face some economic, you know, problems. Also, if you're going to be paying more for housing, then you're not going to have that income to pay for other things. So that's kind of where I'm heading with that.
Any predictions on when we might be in that recession?
Probably if this continues by early next year.
Yeah. Brad, what are your thoughts?
Yeah, I think we are headed into one, and maybe to approach it from a different direction of very, very high level macro.
Hmm.
The past 3 to 4 years have seen strong economic growth. And a big reason for that, and one of the most fundamental principles of macro is that, more people means economic growth. Like it's one of the tightest correlations in macroeconomics is, the more people doing economic activity in a market, the bigger that market is. And we're quickly shifting from adding 2-ish million people a year to adding pretty much no one a year.
Hmm. Hmm.
Immigration for a lot of reasons has nothing to do with mass deportation, which is not happening right now. But like, we've kind of given a signal as a country that like we're not open to immigration right now. And so you see that at, a skilled level where, applications and interest to for, skilled immigration programs, student visa programs, obviously a lot of noise around that right now are dropping. And, crossings of the southern border, like legal and illegal, have basically fallen to zero. And, obviously people have different views on illegal immigration, and there's reason for sure to oppose it. But like from from macroeconomic view, it kind of doesn't matter whether people are here legally or not. If they're working, they are contributing to the economy. And I think we're going to go from a world where we have, solid 1.5 to 3% economic growth a year to a world where the baseline is like zero point 0.5 per year. So small shocks, a shock to the housing market, less construction, a supply shock from tariffs can easily send us into a recession just because that baseline of growth is lower. It's a little bit of a technical answer, but I would be very surprised in the next, 2 years if we did not slip into a recession and possibly a severe one.
Hmm.
You
Yeah, I
think
would
it'll be
agree.
severe, Brad?
I certainly think it could. I think there's it's just we're entering a pretty fragile position as a country. There's deglobalization happening right now. We don't totally know the impact of, having a baseline, probably 13 to 15% tariff is where most people think it'll shake out. I mean, that's back to, 1930s level. It's back to Smoot-Hawley level tariffs. Like nobody really knows the impact of this. We're just basically running a macroeconomic experiment in real time. And
Hmm.
I think there's, most cooler heads that I know are like, we'll probably be okay. But there's certainly a view that like we've set ourselves up. There's also the deficit. You know, that's
Well, the spending bill is not going to help.
no, I mean we're running, I mean, who knows by the time that, when this airs, like what'll have happened to the spending bill, but like, we've been running in a full employment economy,
You know,
6 to 7% deficits per year, and that's only going up. And I have to believe that, especially as the US retreats from the world stage, like the bond markets are eventually and the currency markets are going to see that. And that's the kind of thing that combined with like lower population growth, combined with the tariffs, could just like set us in a tailspin.
I agree with both of you, though, Brad, I think I might agree with some of the cooler heads that you say as well. We're in a real time experiment right now. So all indicators would suggest that I would say Q1, Q2 of next year, Ryan, to your point, I think there's serious probability that we're in a deep recession for all the factors that both of you have stated. That being said, this our economy has survived many turbulent times before. Maybe nothing to the magnitude of this in the variety of factors that we're seeing at play right now, again, in real time. But I wouldn't be surprised if we weren't. So that, yeah. So I think we're in a vibe session right now, right? Where, unemployment's, hovering around 4.2%. You're not really in recession, territory until you're about 4.55%. Negative GDP growth is trending that way. But for all the factors that you guys have stated, I think we'd be fools to not prepare and start preparing today, as it relates to investment decisions and all of that. And so, incredibly interesting times. I really hope that we're wrong. But with everything that's happening right now, it would be foolish not to predict. And I think Q1, Q2 of next year is about that time. And if we're not there next year, then I would say I think I'd feel a little bit better, to be honest with you. I think if we're not there by that time next year, I'll be able to sleep a little bit better, and unmedicated at night. So yeah. Any final thoughts,
Yeah.
Ryan?
Yes, I would like to say, in our industry, in commercial real estate, we basically have faced a recession since 2022 with
Yeah.
the tightening of the credit and, interest rates now creeping up to 7%. So in our industry, we felt a recession, but in terms of United States as a whole, we haven't gotten there yet, which is pretty incredible.
Yeah, and I think with our industry, and we're seeing this already, people just need to act like we're in a recession, right? And playing it safe. And I think we're already starting to see that, right? For the reasons that we've just stated as well. With regards to diversification of portfolios, people are already pulling back on investments, unfortunately, on the housing starts for a plethora of reasons. So, anyway,
But
that being,
but in your
yeah.
case, I would really like for you to be able to sleep well at night and not have to take on medication.
Eh, you know, no, I appreciate it. Yeah, I appreciate it. Certainly not just because of the impending recession and the geopolitical state in which we live. That being said, let's move on to one of your guys' favorite topics, New York City Local Law 97. Let's kick this up a little bit if we haven't already. So, New York City Local Law 97 compliance date kicks into full swing in June next month, 2025, a bit delayed from the initial May 2025 announcement. So, and depending on who you ask and who you are talking to, this is either a long overdue climate intervention for the built environment of New York City or one of the most poorly timed and implemented climate reduction acts ever passed. So for those of you listening that need a little bit of reminder what Local Law 97 is, it's mandating very aggressive emission caps on buildings over 25,000 square feet, or the owners will face very hefty fines. Theory being decarbonize the built environment. The challenge, retrofitting is incredibly expensive. Technology is not quite there yet. And the incentives are fuzzy at best. So we've got two of New York City's finest residents and experts here with me today. How lucky am I? So guys, I gotta know. This is kicking. We've been talking about this for a long time right now. It's coming online next month. What are your thoughts? Is this actually going to move the needle as is on decarbonization of assets in New York City? Is it necessary at all? Was there a better way of doing this? I'm going to step out of the ring and let you both duke it out right now. Who wants to kick us off?
Sure, I'll start. And look, I'll preface this by saying that like I'm not some rightoid when it comes to climate. Like I believe climate change is happening. I believe it's caused by humans. I don't think it's a hoax. I think Local Law 97 is and laws of its ilk are some of the dumbest things to come to the real estate industry. And it's important. The reason for that is it's important when you're making policy and you're writing a law to enact it at the right level. So
Mhm.
you can think about like if you were to enact a wealth tax that's specific to one state, that doesn't make a lot of sense because people just leave that state. It's, you can't have that kind of punitive policy at a state level. You need to have that at a federal level if you're going to have it. I think it's the same thing with this. You're taking the densest most environmentally friendly place for people to live in the country. A majority of New Yorkers do not commute by car. They use public transit, they walk, they bike. They tend to have small units that are highly energy efficient because they share walls, floors, ceilings with other people. And that doesn't mean everyone wants to live like that. That's fine. But clearly a lot of people do want to live like that because it is the highest rent market in the country. So clearly if people didn't want to live like that, the rents would not be so high. So what you're doing with Local Law 97 is you're making it more expensive. You're adding cost, but you're only adding cost because it's a local law. That's what it is, New York City law. You're only adding cost in the 5 boroughs of New York City. So if you make it more expensive to live in New York City, what does that mean? It means people are going to leave. They're going to move to the suburbs. They're going to move to suburban New Jersey, to Westchester County, to Long Island, where you don't have laws like this.
Hmm.
Nobody is coming around to your single family house in Great Neck, making retrofit your boiler to be more energy efficient. It's not happening. Or they leave the New York metro area entirely. They go to suburban Atlanta, they go to suburban Phoenix, somewhere else. And all of that is net on net worse for the environment. So in my view, this is one of those laws that, looks great from a narrow focus of like, hey, we're going to take these buildings and, these owners and we're going to hammer them and force them to upgrade everything and do all this stuff. But from a macro standpoint, it almost certainly is going to be net positive in terms of more carbon going out into the environment, just based on how it impacts costs and moving patterns. So the idea that this is in any way a win for the climate is, in my view, completely misguided.
Very important breakdown, Brad. Ryan, would love your thoughts.
I'm just so confused, Brad, how you were such a proponent of congestion pricing, but for this, you're not for it. It's going to create like green jobs. You're going to have like less air pollution. I mean, that's the whole argument about congestion pricing, right?
So congestion pricing replaces one cost with another. Congestion pricing takes a time cost and replaces it with a financial cost. So like driving into New York City is expensive regardless. And you're either paying with your time, that is, you're sitting in traffic waiting to get into the Holland Tunnel for 45 minutes, or you're paying $9. And so by replacing that time cost with a financial cost, you get more efficient behavior. More people take transit. People don't have to sit in traffic that long. The people who really do need to drive, delivery trucks, et cetera, can get through faster. Um, so I get why it seems contradictory. On one hand, I'm like, some hardcore, ecologist here saying
Right.
like, we need congestion pricing. On the other hand, I think local law 97 is stupid. I think from an economic standpoint, if you step back and say like, how should we be taxing behavior? It's not totally contradictory because there's a cost to driving into New York City one way or the other. You can't say the same. This is a new cost on buildings that never existed before.
Yeah, listen, I think that they're not going about it the right way right now because I do think that small and medium-sized building owners are definitely going to get hit the hardest, or they're just going to pay the penalties and not care about doing any of the retrofits that they're required to do.
Right.
Uh, I I think that the program makes sense. I think there's a lot that needs to still go in to make it work effectively. And if I was Mayor Adams right now, I would probably go and hire the top 10 energy or sustainability consultants that are out there in New York City with a proven track record and get them to the table and figure out the best way to go about this. Education wise, because I still think there's a lot of building owners that probably don't even know what local law 97 is. And I'm not really kidding about that. I'm
Yeah.
serious. Yeah. And then what are some like low measures that they can do to save on energy? And then they could kind of gradually go up from there. I think that's really the key. I didn't even know about this, but I was like researching this before our recording. Supposedly they have a 28-page plan called Getting 97 Done, and it kind of gives a breakdown of what they're trying to do to help building owners figure out what's the best measures to take in order to lower their carbon footprint, and then also providing case studies, which was only three cases, which I don't think really was helpful. But listen, they have an NYC accelerator, which is like a technical assistance program. I think they could do a lot better job with that. That's why I'm saying you got to hire these consultants, because I don't think this accelerated program is doing enough to kind of educate or helping with implementation. So that's what I think there. And then I see that they're trying to do some type of financing and funding action by partnering up with NY State, with Con Ed, NYSERDA, National Grid, implementing like J51 abatements, which I think will help owners if you create that type of incentives. Uh, and they're thinking about helping owners with like understanding the Inflation Reduction Act funding and kind of seeing if they could use that into reducing their carbon footprint, uh, promote PACE financing, helping owners with the industrial and commercial abatement program. I think there's a lot of ways for them to get that incentives, especially for like upfront costs. Because I know building owners right now, even when you're talking to them about implementing tech, they don't want to pay the upfront costs.
Right.
But if you can help them with financing that upfront costs, and it could get put into, let's say, monthly installments, or I've read
Yeah.
that they would put it into a property tax bill that you would pay at the end of the year. Maybe that would alleviate that issue, and they would say, okay, based on a cost benefit analysis, all right, it makes sense. We can probably get this upfront financing, help reduce our penalties, and we're reducing our capex. So I think there's still so much that needs to get done before I see building owners making any type of serious measures.
Yeah, Ryan, I tend to agree with you. I think it's, and I'm not a resident of New York City, so I'll give that caveat right now. But I think it's the right idea. I think it's the right goal. I think it's absolutely wrong means and wrong execution for a lot of the reasons that you just stated. I don't think that it's a goal that should not be tackled, but I do think that New York City could be going about this in much more effective ways that will actually result in value add, that will actually result in shocking, actually achieving the goal, as opposed to just adding headache and friction to an already pretty big problem, or perceived problem, I should say, in the city. So it kicks off next month. We'll revisit this on a future episode, so I'm very interested to see how this plays out in New York City, and what, if any, modifications we'll see a year from now, or if the law's even still kicking. So, any final thoughts, guys, before we move on to the next segment?
No, I do want to agree with Ryan that just like it, one benefit of this silver lining is that it has really built out the finance ecosystem around these things, because a lot of these retrofits, like, yeah, some of them do pay off in the long term, some of them do, some of them don't. But the ones that do, certainly you can create financing instruments around. And that being a robust ecosystem of like, there's plenty of, government and non-government financial sources that can back these things. That's a good thing. And I'm glad to see
Mm-hmm.
that.
Brad, I have a question for you. Do you think if you tell owners you got to go to a specific amount of workshops to educate yourself on local law 97, and if you go to these workshops you won't face any penalty for X amount of time, do you think that could be a better way to go about this in for the short term?
I'm just so curious to see how owners try to get around their attendance requirement to these workshops. And then you have like, institutional owners, family owned, like, who do you send? Do you send like, the patriarch, the kid, the asset manager? Like, so I think offering that stuff is great. I just worry about how you enforce attendance for owners on this kind of thing. So
This whole new gig economy will emerge for people that are hired to attend these workshops.
yeah, it's gonna be
Just joking.
it's gonna be quite the scene.
No, I'm just joking. No, I'm interested to see how this unfolds. As always, in my style, cautiously optimistic, but we'll see. We'll see. Maybe the barometer will be moved a little bit, but that being said, I don't think it will be with the law as is. So, to be continued. Great points, guys. Thank you so much. With that, we're going to take a really quick break right now to have a conversation with our good friend David Abrams from our sponsor HILO, and we will be right back to wrap this up with Brad Hargraves. So stay tuned.
So happy to be joined again with David Abrams, CEO of HILO and the host of the Tenant Experience Network podcast. David, how are you today?
I'm great. I'm great. Thanks for asking. How are you?
We're doing fantastic. Thank you.
We're good. Would love to hear what's going on in your world and what's new, David. I know you've been on the road a lot.
Yeah, no, doing a little bit of travel, just back from a whirlwind trip to Edmonton, Calgary, and Vancouver, out west in Canada, and lots to talk about that whole experience. But more importantly, it was a great opportunity to continue to roll out HILO and onboard new buildings in all three markets. Really excited about.
Congratulations.
Thank you. Thank you. Excited about the growth, excited about engaging with new building partners and reaching new audiences. And of course, it's all as we continue to support building operators who are making that effort to really ramp up the physical workplace, make it a destination of choice, or as we like to say, a place where people want to be. It was an awesome trip. I think you'll agree it's no longer really just about being either remote or 100% in office.
Mm-hmm.
It's about being in the right place at the right time, doing your best work, and that's either individually or in collaboration. I think that building operators, particularly those that we're engaging with, they really now understand what has fundamentally changed in their business. That they're no longer in the space business, that it's really about driving those amazing experiences. And that's what's going to bring people back. And it's also helping to contribute to our growth. So it's been an exciting journey. Also just curious, from your perspective, but this is what I'm seeing, that as more real estate developers are embracing technology, we are definitely seeing an opportunity, and we're seeing a gap in the marketplace that, it used to be they were just all anxious to see the tech, but we don't believe that's what's going to win the day, where we're really seeing an opportunity. And for us, it really speaks to our DNA, having been in the service business before we got in the technology business, the ability for us to deliver great customer support and great customer service is not only a differentiator, but it's sort of changing the conversation, where all of a sudden they're just as interested in that part of our business as they are in the technology side. Have you seen that at all, or any thoughts on that?
Oh yeah. I mean, I'm drawing back to even the days when I was doing, customer success for a prop tech, where that was the differentiating factor, right? That ability to remove as much friction as possible from, the change management and everything that your end users are going through, and to be able to provide as seamless and enjoyable of a process as possible to carry as much of the load.
Yes.
Absolutely. Absolutely. And back then, we were kind of unique in that, our end users were attorneys, in-house attorneys with real estate companies. And the founder of our company intentionally recruited attorneys, knowing that kind of rapport and trust would be able to be built. So David, I think we're seeing an increasingly, absolutely, especially because there's so many more options out there that people can engage with in terms of technology. So that's definitely going to be the differentiator, 100%. And I know you guys are providing that same white glove service.
Yeah, and to harp what Nadine is saying, it's really important for vendors to think about not just signing the contract, but that hand-holding process to get the end user to feel comfortable using the product or the service, right? And we've had countless conversations about this, David, about the hand-holding and having that feeling safe and security using the product and being able to then feel comfortable moving on without you to, to just use it on your own, right? So
100%.
it,
That investment that we're making now is all about helping them to optimize, so that at renewal time it's a no-brainer. And if we just leave them
yeah,
alone, we're finding there to be a huge gap. And I just had a new business meeting earlier this week, and I got some feedback after the meeting. And the feedback was that the way we speak and the way we presented ourselves and the way we talked equally about our tech, but equally about our support, our service, our commitment to helping them grow their business, that was a game changer in terms of how we came across as a potential partner. So I'm glad to see that you're starting to see that, and that maybe that will be a theme that will start to differentiate and start to separate, the really great platform solutions from the not so great.
Well, no surprises
Was
there.
also being on this trip was also a great opportunity to practice this whole notion of work from anywhere. So as much as I'm a firm believer in being in the office at the right time, I just want to say that, I don't just think that it's only one way or the other. I was able to work from anywhere. I traveled from Edmonton to Calgary to Canmore, Alberta. I then went on to Kelowna and on to Abbotsford and Vancouver, British Columbia. I was able to remain fully engaged with our business, and really just then able to not only get work done, but just also enjoy some just incredible country, scenery, food, wine, visiting with family and friends. And I think that that's a wonderful place for the business world to know that we can, be out on and doing business, but also take advantage of the opportunity to visit new places. And so it was an amazing experience.
Ugh, how could you want to be back in the office full time when you can do that from now and then? I mean, seriously.
There's a time and place. And
exactly.
Right. That being said, I am heading to New York. So looking forward to spending some time in market there, again, meeting with existing partners and new partners. And I'm super excited to be reconnecting with some of our guests who have been on the 10 podcast, who were all recently featured in Commercial Observer's 2025 Power 100 list that ranks the most influential and powerful leaders in commercial real estate. And 6 of our guests, James Nelson, Principal and Head of U.S. Investment Sales for Avison Young, Gary Phillips, Managing Director at Eastil Secured, Peter Regardi, Chairman and President of the New York region for JLL, Sonny Kelsey, of course, co-CEO of BGO, Shimon Shkuri, who's the President and Founder of Ariel Partners, and of course, Bob Knackel, CEO of BK Real Estate Advisors. All guests on the podcast, all included in that illustrious list of the top 100. And engaging with some of them again while I'm out on my next visit to New York. So again, we've got great guests coming up. I'll continue to keep you apprised of all of those that are joining us on the podcast, and we are getting very close to episode number 100. So we'll do some.
Wow.
Yeah. So we'll definitely have something special. Yeah. So all good. So again, thanks for including me. Wishing you guys continued success. Glad to be a part of this conversation, and can't wait till the next time.
Thank you, as always, David, for swinging by. We love your updates, and also all of your support. Thank you so much, David.
All right. We'll see you again soon.
Thanks. All right, and welcome back, everyone. Thanks so much. As you guys know, here on CRE Unplugged and Thesis Driven, we like to wrap things up and have a little bit of fun. And so today, we are playing Real Estate Tech Survivor. What is Real Estate Tech Survivor, you might ask? I'm glad you didn't ask, probably. But we have taken the sponsors of this year's RETCon conference, specifically those in the diamond, platinum, and gold categories. We will be going around round robin style, eliminating one of them, telling you why, and the remaining company will be our Real Estate Tech Survivor. All right, guys, are you ready to do this?
I'm ready.
Good.
I'd like to start with that. I'm sure we think all these companies are absolutely fabulous and out to solve very real problems. So please, by no means is this meant to be an endorsement or vote against any of these companies. But that being said, all right, Ryan, let's kick it off with you. Who's leaving the island first?
I will go with Vantum, prefab construction panels for fast, energy efficient buildings. I just think it's too capital intensive and it's a slow adoption curve in CRE.
Bantam's out. All right. Let's get rid of him. Brad, how about you?
All right. So, we got 30 odd companies to choose from. I am going to boot out premium parking. I mean, we'll have autonomous vehicles. Parking's going away. We don't need parking. We don't need parking tech. Kick it off.
You know what? I
Wow.
went back and forth with that, and I wanted to keep them on. I was like, you know what? Let's just see if they make it. let's just see if they can survive. But Brad said no. Premium parking is out. All right.
Okay.
Let's get these guys out of here. All right. Up next, guys. All right, it's me. I'm kicking RealPage off the island. I don't like
Wow.
drama. It's too much drama with RealPage, and I just don't want to have it. So I'm kicking RealPage out of here. That's my reason.
Okay, we're going out strong right now. I'll say Leonardo 247. I just think it's too much of a culture change to get maintenance teams and regional managers to buy in on this app.
All right. Brad,
Hey,
who's leaving?
all right. So spherexx.com is out. Mostly because they said they've been doing AI solutions since 2013. And honestly, if you've been doing AI solutions since 2013 and I've barely heard of you, you're out.
All
Good
right,
argument
done.
right there.
That's not a thing to brag about. It's like,
No.
yeah, we've been doing it for 12 years and we just got lapped.
Yeah. Yeah. All right, I'm with you. Next up, Zago. I'm kicking Zago out. So we got property management workflow automation. Honestly, anything who's just touting workflow automation, I'm kicking out. Companies are going to be able to build their own bots and
Yeah.
all of that in-house. And so they're not going to need these specialized solutions. So I'm kicking Zago out.
Interplay learning. So this is what, like training simulations for plumbers and tradespeople. I just think it's going to be really hard to scale there.
I like them, but all right, I guess they're gone. Okay.
Oh, I'm
All
sorry.
right,
I like that one
Brad,
too.
who's out of here?
All right, so we're gonna kick out Verifast. There's so many companies doing rental, doing screening,
Yeah.
Yes.
fraud detection. I think it's just a race to the bottom there.
Yeah. I had them as a maybe, but I agree. Let's get them out of here. Out of here. All right. Next up. Hey guys, is Vitality still on the island? We kick them off?
Still on the island. Let's boot them.
Yeah,
Long
out of here.
Island.
Vitality is at again, guys. Automated workflow. I seriously, I just think it's going to be a hard sell for any standalone solutions that are selling automated workflows. When it's going to be way easier for companies to be able to do that themselves. So, Vitality, your vital days are over. All right, Ryan.
Exact State, like all-in-one property management system for small and medium business owners. I mean,
Yeah.
you're competing against the Goliaths here. It's not gonna really work. I'm sorry.
Get out of here. All right, Brad, who are we booting next?
I'm giving 2 dots the boot for the exact same reason I gave the last fraud detection company the boot. There's just a lot there.
Yeah. All right, I'm with you. Okay, next up, I'm kicking off BetterBot. I'm kicking off BetterBot,
Ooh.
guys. Chatbot AI leasing assistant for multifamily. Yeah, it's great. But again, I just think that we haven't even scratched the surface yet with the capabilities of AI. And so I'm not banking on anybody whose whole, product model is chatbots and AI leasing. So bye-bye BetterBot.
Okay,
Ryan.
Reba, I think is just really limited outside of multifamily. So not for me.
Okay.
Reba off the island. All right. I am going to kick off Built. One of the
Ooh.
buzziest prop tech companies, but Wells Fargo is only going to cut them that check for so long. There was a devastating Wall Street Journal piece last year about basically Wells Fargo losing money on every Built credit card.
Yeah.
And, they've got a contract in place right now, but that's it's going to be up at some point.
Yeah.
Well,
Okay.
yeah, I would have Entrada, I know, has built like their own type of built rewards where you could actually get some really much better rewards than what Built's to offer. So there's definitely competition now there.
All right. I'm kicking off mastermind.com. I don't even think it's a tech company. I think this is Tony Robbins.
Oh yeah, that's a Tony Robbins thing.
Yeah, this is Tony Robbins, coaching platform or whatever. So Mastermind snuck on the island, shouldn't be here in the first place. So I'm kicking off Mastermind.
Sensei AI or Sensei.
Yeah.
Sorry, yeah. So AI insights for property management. I think you need to get that proof of accuracy and really build the trust of your clients in order for this to be worth buying.
All
Okay.
right. Next up, I am kicking off PayScore. I probably meant to kick them off earlier, along with all the other fraud detection companies, but I forgot they were here. So now I'm going to kick off PayScore.
Hey.
I feel like I'm cheating. I'm just kicking off all the fraud detection
No,
companies.
it's I
No, it's
I had the
okay.
same
You have
thing.
a niche.
But
I
the
had the
fact that
same
there's
thing.
three of them on this list of 30 odd companies, I think proves my point, I hope.
Yeah. You know what? I'm gonna kick off Predict AP. I just think I think this use case is going to go away very, very soon. I don't see them hanging on for much longer with accounts payable automation of that. So I'm saying bye-bye to Predict AP.
And I see Map Vision. Again, it's like super hyper focused to student housing.
Yeah,
All right.
and for the exact same reason, I'm going to kick off
Senior
Nick.
housing. Sorry, I said student for senior housing.
Oh, you mean Nick
Okay.
Map? Okay.
Nick Map.
Yeah, Nick
Yeah.
Map. Yeah.
All right. So I think from here, sort of, it gets like harder in a bit of a way. I think
I agree.
I don't want to pick any winners, but we're down to like just a handful of companies here. I'm going to kick off Ruckus CommScope. Um, you know, the whole first of all, I took me like three readings of their description to understand what they do, but it's kind of in this broad, multifamily connectivity world, and there's a lot of companies doing things in that right now.
Okay. All right. I got to pick. My next one's gonna be a little controversial, but we're getting there, right? We're getting there. You guys, I'm going apartments.com because I
Yeah,
just
get 'em.
think
Hey.
I think their day is coming, guys. I just, they've had a great run. But I think the days of us searching for apartments on apartments.com are numbered, and something's going to be disrupting that in the near future. So thank you for your service, apartments.com. But we'll see you later. Get out of here.
Amazon Key, I just think there's a lot of these type of access control companies, and just because it has an Amazon name doesn't really change my mind on them.
Okay.
Right. I am actually going to kick off Lively. I think it's an interesting space, these tenant apps, engagement apps, but I think between Venn and Elevate OS, it's a little bit of a crowded market, and I think both those other companies have a step on them.
All right. Keeping in line. I'm just gonna piss more people off. I'm just gonna keep going on. LoopNet. I'm kicking off LoopNet.
Oh
Okay.
wow, off LoopNet.
I'm kicking off Loop. I just feel like these online marketplaces for properties, guys, we're gonna see some big change here. I think in the next few years. I could be wrong, but yeah. So kicking them out of here.
Okay, Intap, gone. I'm not tap dancing with them. Just think it's more prevalent in the legal and finance space, and they have to develop that reputation in CRE too.
How many more do we have, guys?
Okay, so we've got
I think we've got a few more.
hold on.
So I'm going to kick off. There's some of these pretty interesting looking, um, you know, solar, energy
Yeah,
solutions. It's somewhat hard for me to evaluate. So I'm going to kick off PowerFlex.
yeah.
Carbon-free electrification sounds cool. I mean, there's obviously a lot going into space. I don't know if it's the right administration to be betting on them though, given a lot of those subsidies are going away.
Yeah. Okay, now it's getting tough,
Now it's
guys.
getting tricky.
Um, got it down to two here. Hold on. I'm gonna get rid of ZiteView.
Really?
Well,
I like
because
that view.
we got site technologies on here that's doing the same thing. So you know,
Okay.
I didn't like the jibe of their jib or whatever. So whatever, I don't like the way they looked at me. So they're out of here.
Looked
So
at
who
you.
do we have left?
They looked at me.
We've
Are we going back to dating?
We got Cherry. We got Cherry. We've got Elevate OS. We've got
And building
Site
engines.
Technology. Is Site Technology still on?
I think it's still there. Yeah.
Yeah.
Site Tech is still there.
And then what was the other one you said, Brad?
Site Technologies, building engines,
Site Technology,
and
building
Elevate,
engines,
Cherry, and Elevate OS.
So we're down to 4. Oh, all right, Ryan, it's down. You're up.
Let's get Psych Technologies out of there.
Yeah,
I think it's too commoditized.
All right, so we're down to Cherry, building engines, and Elevate OS.
All right, I am going to kick out building engines. Obviously, a lot going for it, but it is threatened by Cove, HQO, and kind of this new generation of tenant management apps.
Wow. Okay. So big decision in my hands, guys.
You're picking the winner.
I know. This is tough because I think they're both extraordinary companies, but I'm kicking Elevate OS out. I've got to go with the data play with Cherry, guys. I got to go with the data play on Cherry. Elevate OS, you played a great game. We wish you could have stayed on the island, but I gotta give the winner
nice
to data.
Partying gifts for you.
Yeah, I got to give the winner to data. So Cherry is the winner of our first real estate tech survivor. It was brutal. It was tough, but we made it. Guys, thank you so much.
A lot of good companies got voted off the island. Probably going to get some nasty emails after this one.
Yeah, we probably are. But anyway, you guys, another great episode. Thank you for your thoughts. Thank you for the laughs. Again, so for all of you listeners, thank you for joining us. Brad, anything coming up with Thesis Driven that you want to announce to our listeners?
Look, we got a couple of courses coming up, teaching fundamentals of capital raising in New York live in June, and our intro to development course coming up as well. So a lot going on. Thanks so much for having me on today.
We love it. Thanks for always joining us.
Yeah. And please subscribe, rate, or review wherever you get your podcasts. If you have any questions, please email us at info@CREunplug, or you could reach us at our website, CREunplug.com. See you next time. And until then, keep your conversations real and unplugged.